Hello everyone, welcome back to this channel. This is your dear trader Arvind Srinivasan. Like I was telling you in my previous video, in order to understand how the stock market functions or what the stock market is, it is important to understand the terms that are involved in defining the stock market itself. So this is the part 2 of the terminologies involved in the stock market. If you haven't checked the part 1 out, please do go check that out first so that we can continue with the other terms in this video. So without waiting further, come let's get started. So the first term we're going to be looking at is the market cap. The market cap or the market capitalization plays a very important role in helping us understand how high or how low the public holds the company to be. So the market cap was calculated simply by multiplying the current market price with the overall outstanding shares. So by outstanding shares, I mean all the shares that are available for the public or held by the institutions, or all the shares available in the market multiplied by its current market price at which it is trading. So this will give us the overall market cap of that particular stock. So based on the market cap, the stocks can be, or the company can be segregated into, say, large cap, mid cap or small cap. And I'm sure you must have heard about these categories. So this value helps us understand how important the company is to the public. So in general, bigger the market cap, the better the company is as far as the public is concerned. The next term that we're going to be looking at is the RRR. It's not the Rajamouli's RRR. It means risk reward ratio. So this is one of the most important aspects in a trader's life, and this plays the most primary role in risk management for a trader. So the risk versus reward ratio simply means how much a trader is willing to risk for a particular reward. Meaning, say if I am risking 1 rupee as the maximum loss say 1 rupee is the maximum loss that I'm willing to take in a particular trade, and if at all the trade goes favorable to my conviction, the reward that I might be getting is 2 rupees when it reaches the target. So the maximum risk here is 1 rupee, the maximum reward here is 2 rupee. So the ratio between the risk and the reward here becomes 1:2, which is basically the RRR becomes 2, which is your reward divided by your risk. So if you have a number or a risk reward ratio which is higher than 1, it is safer, meaning your reward is more than your risk, which means in the game of probability you have higher chances of becoming successful eventually. If at all it is below 1, it means you are risking more compared to the reward. So the next term that we're going to be looking at is the P&L. So P&L basically means profit and loss. So the P&L statement shows us the profit or the loss that we made in our portfolio during our trading. So the gross P&L simply means the overall profit or loss that we made, and the net P&L means the profit or loss that could be withdrawable after considering all the brokerages and other deductions. Apart from this, there are two other terms that you might hear. One is your realized P&L and the other one is your unrealized P&L. The realized P&L is your actual profit or loss which is calculated after you exit a trade, whereas an unrealized P&L means the profit or loss of your current position in the market, meaning you haven't exited your position, you're still active into the trade, and this is your current state of profit or loss, which is calculated with the difference between the current market price and the price at which you entered into that particular trade. So that's your unrealized profit and loss. Margin. This is a very important term for a trader's career. So margin is the amount that is required by the trader to execute that particular trade, meaning the capital or the investment that is required by the trader to execute that particular trade is called margin. Leverage is a way in which you can execute a trade with lesser margin, meaning you only use a part of your margin, and for the rest of the margin required for the trade you use borrowed funds. So this extra margin that you receive from your broker is basically your leverage. So the leverage can be anywhere between 2x, 3x, 5x and anything above that. So if I say for instance a stock is worth 100 rupees and the broker is willing to pay 10x leverage for that, which means I only have to pay 1/10 of the margin for that, meaning I pay 10 rupees and the other 90 rupees is paid by the broker as a leverage to execute the trade. So the leverage is definitely a double-edged sword, meaning when I lose 1 rupee in that leveraged trade, it means I am losing 10% of my capital, because my original capital is 10 rupees that I've invested in the thing. The same way, if at all I make a 1 rupee profit in that 100 rupee stock, I make a 10% return of investment in my original investment, which is 10 rupees, right? So the leverage helps us to fetch more returns and also makes us exposed even more to the market. So it is definitely a double-edged sword. Position sizing is one of the very important things that makes or breaks a trader's career. Position sizing is the primary aspect when it comes to risk management in any trade, and it is a whole other topic by itself. But for now, position sizing basically means it is a way in which you identify the size of your trade, meaning now that you identified which stock to trade, say for instance I am looking at trading Ashok Leyland stocks, so I know I have to buy Ashok Leyland stock, but how many shares should I buy? So position sizing is the way in which I identify the number of shares to be bought in that particular share, right? So this works on the basic principle that the risk involved in that particular trade is fixed and the quantity of the shares that I buy varies depending on the current market price. So position sizing helps us mitigate our risk and thus keeping our maximum loss fixed. So that is what position sizing basically is. Volatility is the term that is used to define the rate at which a particular company's stock price fluctuates or moves, right? So we already discussed about trend. Trend is the change in price in a particular direction, either upwards or downwards, whereas a volatility, it doesn't specifically mention the direction of change in price, but volatility simply defines the rate at which it changes, meaning how fast a price of the company changes from A to B. That is what volatility means. So when I say the market or the price is highly volatile, it means it has shifted its price from A to B in a very short span of time. Whereas if I say the market is not volatile at all, it means that the market is moving in a very slow pace and it doesn't make any rapid movements immediately. So for a trader, volatility is definitely a friend. his or her friend, and that is the one of the most easiest ways for a trader to make money in a quick way. Now, this is another term which sounds very complicated but is actually not. Liquidity. We must have also heard this, right? So, liquidity, liquid cash, liquefying an asset. So, liquidity is basically the ease at which you can convert any asset, say commodity, real estate, shares, whatever it is, into hard cash. Since cash is the most liquefiable asset, so we generally compare it with cash. So the easier a particular asset is to convert into cash, the more liquid it is how we measure it. So liquidity is a trader's one of the most primary criteria for a trader to execute the trade smoothly. So higher the liquidity, the better it is for a trader to scale up the trades also. So that's what liquidity basically means. Hedging is nothing but the process of mitigating your risk, meaning it is a way in which you minimize or reduce your risk in a particular trade. For instance, I've already taken a position in the market, say for example, to buy Mahindra and Mahindra shares, right? So I bought equity shares of Mahindra and Mahindra. Now, if at all the market is not favorable according to my conviction, and if at all the price falls down, then I might end up shorting shares of Mahindra and Mahindra in options or futures in derivative segments to hedge the risk involved in the equity shares that I hold in Mahindra and Mahindra. So basically it is your counter action to the already existing action in the market. So this is a way in which you counteract your existing position to reduce your risk. That is what hedging means. So these hedge funds are organizations which manage your funds or assets by hedging them across multiple asset classes to minimize the risk as well as to protect your capital and multiply it too. So that is what hedging basically means. We've come to the end of this video. These are some of the many terms that we use on a daily basis in the world of stock market. So if you think you learned something new through this video, please do click on the like button. And if you think I've missed out on any terms, please mention the same in the comment section. And I'm sure we all have that one friend who keeps saying stock market is way too complicated for me. I never understand what they talk in the world of stock market. So if at all you know someone who says that, please do make sure you share this video to them. I'll see you in the next video with another interesting aspect of the stock market. Until then, it's your dear trader Arvind Srinivasan signing off. Bye bye.